Is the commercial real estate getting any better? There was a building in downtown San Diego that was sold at 20% of its value. There was another one that was sold at 10% of its value a couple of years ago in San Francisco.
This time's different, okay, because this is the unicorn event, as you might call it. COVID has changed everything.
My guest today is David Marino, who's a real estate expert that's on the ground, walking a lot of office buildings. He knows what's happening.
Early last year in 2024, we already saw office landlords starting to get foreclosed upon. You know, and these things don't make headlines, right? It's not like the local newspaper, another high-rise foreclosed upon. Its own ecosystem where people and institutions don't want to talk about the failure.
He's here to tell us where we are in the down cycle of commercial real estate in California and beyond. I'm Siamak Khorrami. Welcome to California Insider. David, it's great to have you on. Welcome.
Great to see you again. Thank you.
You know, we want to talk to you about commercial real estate. You're in this space, and we have been hearing about office space not doing well, commercial is not doing well, but you have a bigger perspective into what's going on across the board in different types of assets. Can you tell us what's happening?
Yeah, so before I talk about what's happening, I think it's worth having a lens on my point of view and my experience. So our firm, David Marino, it's a national company, and I'm 100% client-facing in the firm. So even though I'm a co-founder of the company, I've been doing this for 35 years, I remain 100% committed to actually personally being the tip of the spear and representing clients. And what we do is represent tenants only across industries, across size ranges in the leasing of space. So it could be a renewal, expansion, subleasing, downsizing, restructuring, relocation, anything, or a building purchase that they might do for their own account. And so we're representing business owners and executive teams and shareholders in representing only them and not the landlords around the country in doing these kind of strategic planning and transactional activities. And so the lens that I have is very much on the ground. And I do work in research lab, manufacturing, distribution, and corporate office and regional office space. So I'm doing work probably in any given year in 20 different states and do personally about 100 different transactions that I'm touching, and my team does literally thousands. And so we are a very good bellwether on how corporate America is behaving really nationally, across industries, across the office, lab, manufacturing, and industrial segments. And seeing this from the business owner's lens, not from the landlords or property management perspective or the ownership perspective, but from the business owner's perspective of helping them understand.
People who are renting the property.
Exactly, the tenant, the user of the space, right? Top line, you really excluding retail, have three different categories of space. You have office, industrial, and then research lab facilities. And the office sector was hit hard and immediate as a result of COVID. You know, when in 2020, all the employees within about a 2-week period were told to go work from home, you know, I always think had the internet not existed and had this happened 20 years before, everybody would have been back to work in a month or two. Okay, but because of Zoom and remote working and internet connectivity, people got very productive very quickly working from home. And I immediately saw CEOs and business owners responding favorably to what they were terrified about, which was people not being in the office. People got working at home effectively, comfortably, and this persisted for months, now years. And 5 years now, post-COVID, the business owners are having a lot of difficulty getting all the horses back in the barn, right? Behaviors changed, people have moved all over the country, remote working has become generally acceptable. Hybrid working has become more often than not the standard. Many corporations still don't have policies. You'd be shocked. Over 50% of the companies we talk to still don't have a return to office or remote working policy. They're completely laissez-faire and sort of let the employees do what they will as long as they're productive. It's shocking, actually, how little leadership there has been around this. And even those that do, don't fire people.
Because they can't enforce it, probably.
Yeah, it's essentially unenforceable, right? It's strongly encouraged, strongly recommended. And you're seeing some headlines, right, about some big companies threatening to enforce, threatening to terminate people. But most corporations in the country, particularly businesses smaller than 500 employees, just aren't willing to enforce this and generally seem to be doing pretty well with hybrid and remote working. So the net result of that is companies need less office space. Okay, so as COVID began in 2020, corporate America started shedding space, either not renewing their leases, putting space on the market for sublease, or when their lease expires, downsizing. And so we now have 5 years of lease expirations where corporate America has given back millions of square feet of space every year back to building owners and landlords, and generally availability rates around the country have hockey sticked. And it's going to be another 3 or 4 years of carnage of this because there's still a lot of leases that haven't expired. So there's a lot of 10-year leases, particularly in big metro areas, that were signed pre-COVID that still have yet to expire in the next 3 years. And we know by touring those companies' spaces that they're all sitting around on way more space than they need. So there's a lot of space still to come back. There's another big shoe to drop. And then you have industrial.
So the space is contracted, they're under contract, they're paying rent, but then in a few years from now, they will not do that because they don't need the space.
That's right. And we go out and walk space for a living. This is what we do. We're in the market. We're touring space with tenants, helping them understand what their future requirements are. And generally, we see companies sitting on between 20 to 50% more space than they need. So these are companies that have signed a 10-year lease pre-COVID for 20,000 or 200,000 square feet, and they're in partial occupancy. They're on multiple floors. They've already baked the rent into their cost structure. But when that lease expires, they're all generally going to get smaller. It's just a question how much smaller. And it's this sort of death by 1,000 slices thing where as thousands of leases expire over the next 3 years in each metro area, and let's say 80% of those companies get smaller, it's going to be a consequence, right? The amount of space given back versus what's retained or leased is going to be significantly less. So we'll talk about kind of the numbers, because most metro areas are now above 20% availability, some like Denver 25, San Francisco 33. So these are historically high availability rates, but you only have San Diego County, Orange County, Miami that are in the high teens. Pretty much every metro area otherwise around the country is above 20%, and that is the red zone for landlords. Once it's above 20%, it's clearly a tenant's market. Landlords are in turmoil. If it's below 10%, it's a landlord's market, and that range in between 10 and 15 is generally equilibrium historically. Above 15 means soft market territory. Above 20 is the red zone. So a lot of office landlords have significant turmoil today, and it's going to probably get worse over the next 3 years.
Now, what about the industrial space? Because industrial was booming, right? Rents were going up significantly.
Yeah, all that's true. So when COVID started, very quickly, the consumer moved to online purchasing, right? They stopped going to their local grocery stores. And by the way, the government gave away trillions of dollars of money, right, at the time. And what did consumers do? They started spending, right? So their home improvement projects, Pelotons, you name it, people were spending trillions of dollars in the economy. Well, most of that spending was online. And so overnight, big retailers like Target.com, Walmart.com, Amazon needed tens of millions of square feet of space in big, big buildings that there was an extreme shortage of. So there was a run on big buildings. Anything over 100,000 square feet, you almost couldn't find in Southern California. Like back in 2022, in the entire Orange County, LA region, there were only about 9 buildings on the market over 100,000 square feet. Okay, now there's 100.
Wow.
Okay, so what happened was you had this huge buildup by real estate developers in 2021 and 2022 to meet this demand. Well, but developers kept going. So in 2023 and 2024, developers built another 1.2 billion square feet of industrial buildings around the country, mostly in the Sun Belt. So Inland Empire, Phoenix, Dallas, Atlanta, Denver. So 500,000 to 1 million square foot facilities. And so if you were
big industrial
huge industrial buildings for the e-commerce companies that they thought would continue to grow. Well, by 2023, we had started to normalize, right? Consumers started going out again. Online sales became into equilibrium. And so the Amazons of the world had as much space as they would ever need. In fact, Amazon has been a sublessor trying to get rid of space in the last 2 years.
So they're cutting back.
They're reducing back, right? They're now rationalizing their portfolio, and they're trying to move into owned real estate or custom-built buildings that have multiple levels in them, as opposed to your traditional warehouse building, which is typically a single-level distribution environment. So Amazon has changed how they use real estate. And because of their low cost of capital, they've shifted to owning as opposed to leasing. Demand evaporated by the end of 2022. Meanwhile, supply kept coming, okay? And so now, across the country, because of the Amazons and others wanting to sublease space, there's actually more space for sublease in warehouse inventory around the country than office space.
Wow.
You know, everybody
So
talks about this glut of office space. There's 220 million square feet of office space for sublease around the country. There's 250 million square feet of warehouse space available for sublease. So the industrial side is now getting hit really hard, but nobody's talking about this, right? Because
most people thought most people are saying the industrial is okay.
Well, that's right. That's right. Because what happens is landlords and their brokers want to create a narrative that the market's still strong. Because they still have
higher rates.
Yeah,
right?
because they still have the same asking rates today in 2025 as they did in 2022. Okay, but compared to 2022, in Southern California, availability has tripled. Okay, most markets around the country, availability rates have gone up 50% at a minimum to 100%. In fact, if you measure 2020, pre-COVID to today, availability rates are the same or higher in every metro area in the United States for industrial space. Okay, but landlords are holding on to these 2022 prices because that's when they built these buildings, that's when they financed them, and the brokers are sort of singing to that sheet music and trying to convince business owners and tenants that it's still tight and it's a landlord's market. It couldn't be further from the truth. I always joke about what commodity has availability rates double, or in the case of Southern California, triple, but yet the price is the same. You know, it violates all fundamental economic theory, right? That shouldn't be happening. The price should be adjusting accordingly, in theory, back to pre-COVID levels. Okay, but it hasn't happened. Well, why? Well, because, and I'm not a big conspiracy theorist, but the reality is brokers and landlords cooperate. They anchor off each other, and none of them want to see the market go down. And so what they'll do is there is a cooperative competition between them where they share information, they understand what the comps are, and they just don't want to break ranks, or their capital structure is such that they can't break ranks. And so you have this false bottom in the market today where business owners should be paying a lot less for industrial real estate, but the market hasn't adjusted yet. And that's the fight I'm fighting every day in the marketplace, is to get the market down to where it should be and get landlords to behave in a way they should be, competing for tenants that we represent.
We are honored to be sponsored by Shenyun. I've been attending Shenyun performances every year as they change the choreography and music. Shenyun takes you back in time to the magical world of ancient China with unique blend of brilliant dancing, beautiful costumes, and legends coming to life. Overall, it's a very meaningful performance with a lot more than just entertainment to offer. Make sure to go see it this year. Go to shenyun.com and book your tickets today. I highly recommend it.
People nowadays go to the doctors, the psychiatrists for pills, for antidepressants. This is the antidepressant, the best.
I knew it was going to be good. It's a billion times better than I even thought it would be.
I'd heard people say, you don't want to miss this, and I would fully agree.
I'm going to tell everyone to come see it. You have to.
Definitely going to come back next year.
Totally inspirational. You have to go see this.
It's a once-in-a-lifetime must-see that will change their lives forever.
Now, what about the lab space? And this is something a lot of people may not think about, the lab commercial real estate. Can you tell us about that?
Yeah, so this is particularly true in San Diego County, San Francisco metro area, the Boston metro area, Seattle, and some other secondary markets. But these are the research hubs of the country. This is where the Pfizers and the BDs of the world and the Bristol-Myers Squibb, the Genentechs of the world operate, right? These are the research centers historically. And it's rooted back to really the mid-century. If you look at the big research universities, the big not-for-profit research institutes, you know, this is where they're centered. So for example, in San Diego, you have the Salk Institute, Sanford Burnham, UCSD, Scripps Research Institute, a dozen other not-for-profit research institutes that are doing cutting-edge science. And then you have biotech companies spin out of those. So if you look at the big three, which are San Diego, Boston, and San Francisco Bay Area, what happened immediately after COVID is there was a run on life science lab space. Demand was essentially insatiable overnight.
Because the money got poured into...
Yeah, because of COVID, money started flowing into the biotech research sector in terms of the capital markets. The venture capital industry, the IPOs were all very rich and robust during COVID, funding billions of dollars of money each year into biotech. And so biotech companies needed more space overnight that wasn't really planned. It wasn't available for them. And simultaneously with the office sector getting soft, landlords realized that you could convert office buildings into lab buildings. Capital on the demand side went into biotech demand, and on the supply side into converting office to lab. You had this convergence where biotech rents basically doubled between 2020 and 2022. And there was essentially single-digit availability, low single-digit availability. Well, in 2023, the biotech capital markets slowed down, and this growth stopped. And simultaneously, all these big buildings continued to get built that were planned and permitted and designed in 2021, 2022, where now you have in Boston, for example, 10 million square feet of new construction that is finished or finishing, and there's no demand. Nobody wants it. Meanwhile, simultaneously in Boston, corporate America is getting smaller. The capital markets are still tough. Venture capitalists aren't investing. And so you have a contraction of the biotech sector on the demand side. So if you take Boston, for example, there's 100 subleases on the market, 100 wet lab subleases, everywhere from 2,000 to 100,000 square feet, totaling 3 million square feet, and there's no demand for it. So you've got a rise of sublease inventory, new construction, and these office buildings that were converted to lab. And you now, in San Diego, Boston, and South San Francisco area, have about 25% availability. So something that was 3-4% availability back in 2022 is now 25, 30% and growing. So simultaneously, you have this chaos in the office sector, this overdevelopment in the industrial sector, this overbuilding and overconversion and subleasing in the lab sector, and all three categories of commercial real estate are now under siege. It's a very, very difficult market for landlords, but a great market for tenants and business owners.
Before we get into impact of all of this on the community, is this the first time you've seen something like this?
This is my fourth downturn. So when I got into the business in the late 80s, in the early 90s, we had a massive commercial real estate downturn, primarily in office space. And it was the result of the savings and loan industry overfunding and the international capital markets, Japan, Canada, flooding the U.S. with capital and a very liberal regulatory environment allowing for a lot of overdevelopment. So too much office space, a contracting economy, a huge bust in commercial real estate where most high-rises around the country went into foreclosure or receivership in the early 90s. It was a really dark time in commercial real estate. Then we had the tech wreck of 2000, right, where the capital markets fell off the edge and internet companies got wiped out. And there was, again, in office space, sort of a short-term decline and recession around office space for a couple of years. But it recovered pretty quickly. And very few landlords were catastrophically affected by this because the interest rate climate was fairly strong for building owners, where lenders were willing to do extensions of loans and interest rates were low. And so most landlords were able to survive that. Similarly, in the financial correction of 08-09, landlords, because of low interest rates, were able to maintain their ownership structures and sort of muscle through it. So again, difficult times, but not catastrophic. This time's different, okay, because this is the unicorn event, as you might call it, right? COVID has changed everything. COVID has affected how the office sector, the industrial sector, and the lab sector have all responded. The damage that will be done to all three sectors of that will be catastrophic to building owners, and it's already started. Okay, early last year in 2024, we already saw office landlords starting to get foreclosed upon. You know, and these things don't make headlines, right? It's not like the local newspaper, another high-rise foreclosed upon, right? It is its own ecosystem where people and institutions don't want to talk about the failure, right? The landlords don't want to talk about it. The lenders certainly don't want to talk about it. The brokers are paid not to talk about it, right? And so you have to almost be on the inside to know this is happening. And you might, in the business section, see some sort of small press release about, you know, Symphony Towers in downtown San Diego selling for, you know, $90-some a foot, okay, which put into context pre-COVID, that would have been a $400 to $450 a foot building. Right?
So 25% of its
so
its value.
Arguably 20% of its value, it sells for in an arm's length transaction compared to its pre-COVID price. Okay, and that's what we're seeing right now in these assets, particularly in downtown areas when they get foreclosed upon. There's no debt market for these things, and nobody wants to touch them. And so we are in a catch the falling knife environment where we don't really know where the bottom is of this asset class. And there's another $1 trillion of debt that's going to expire in the next year around office space and commercial loans. And a lot of that isn't going to get refinanced. It's going to get foreclosed upon. So there's a lot of turmoil to come for commercial real estate landlords that have debt coming due in the next 2 or 3 years. And by the way, interest rates now are 6.5% from 3%. And so even if your building occupancy and rent level is reflective of what it was pre-COVID, and most aren't, right? Most are getting less rent with a lower occupancy, your debt service is going to double. So these refinancing windows that have opened up have created a real problem for landlords. It's going to be a tough time. It's going to look, by the time it's over, much more like the early 90s than any kind of real estate adjustment we've ever seen before. Because this consequence of COVID is now permanent, right? You see headlines talking about Goldman Sachs coming back and, you know, certain companies demanding their employees come back 5 days a week, Apple, but they're really the exception, not the rule.
You don't see it in your customer base.
It is not happening. The reality is, in the thousands of companies we represent every year, less than 5% are demanding their employees come back full-time. They have essentially given up, okay, or it's working good enough, or it's become a entitlement for employees where people will leave, you know, and there's all kinds of data out about that, right? Surveys that 30 to 50% of people will get their resume out if they're forced to come back 5 days a week. And you have this bigger problem that pre-COVID, I had clients that might have 100 or 500 employees, and everyone lived in that county within commuting distance. Well, now these same employers, their employees live in 20 or 28 different states. Like, employers have had between 10 to 20% of their employees leave the region where the job is. They've moved to Tennessee or South Carolina or wherever they've moved to, right? Gone back to family, lowered their cost of living, right? Wanted to buy a house but couldn't afford to in Southern California. Now they're in Des Moines. These people are working remotely and effectively. The employer's gotten used to it. The employee's happy, and the retention has been high. Well, how do you force everybody back to the office if 50 or 150 of your employees don't even live in the county anymore? You know, it's essentially impossible, right? And they claim it to be discriminatory. So, and then what I've learned is that there's nothing wrong with office space, right? Office space is highly amenitized, beautiful, safe, attractive, has, you know, maybe free lunches, free Diet Coke in the refrigerator, like, you know, and there's people there, it's exciting. It's the commute that's the problem. And if you quantify the cost of the commute to the employer and employee, the economics are somewhere around $5,000 to $8,000 a year of real cost to an employee having to commute.
The time that they're spending.
The wear and tear on the vehicle, the fact that maybe they don't even have a car anymore. Like, some families have downsized the number of vehicles they have. The cost of parking, the cost of mass transit, the cost of the space, right? So it's a real thing for employees. Like, if you're commuting to downtown Los Angeles and you're having to pay to park $400 per month, you know, that's almost $5,000 a year after tax, right? So somebody has to make $8,000 a year pre-tax just to pay to park in downtown Los Angeles. Well, who wants to do that? And plus you have to drive an hour to get there each way. It's 10 hours a week. Well, what could they be doing with 10 hours a week for their own quality of life or increased productivity for the company? And so the commute is the problem, not the office. And so what you see are employers now trying to move the offices closer to where more people live. So you see a flight out of the downtown areas to the suburbs. So for example, downtown Seattle, availability rates are 30%. But in Bellevue, they're building a new high-rise building. Okay, because...
So in the suburbs is okay.
Exactly. You take San Diego, for example. San Diego has the softest downtown in the country. Availability rates downtown are 40% in downtown San Diego, the highest in the country. Okay, but the suburbs are all bouncing around 18, 22%. You see that in the center city areas, generally around the country, the effect is more extreme because that's where parking is more expensive. That's where mass transit is more expensive. That's where it's harder to get to from where people live. And so people are most resistant to coming back to the downtown areas.
When you mention availability rate, that's like what's vacant right now, right? So do you think that number is going to change? It's going to go up, right, based on what you were saying?
Yeah, so a little different. Our industry likes to talk about the vacancy rate. This is sort of a greater fool problem in that lenders, developers, landlords, brokers all want to talk about vacancy. Vacancy is only measuring a subset of the greater availability. So for example, you're a business owner. You decide that at the end of your lease term this year, you don't want to renew your 20,000 square feet, and you let the landlord know. The landlord puts the 20,000 square feet on the market for lease. It's not vacant because you're still here. You're still paying for it, even though next year you're going to be zero and you're 20,000 square feet now. Or imagine you put your space on the market for sublease. 20,000 square feet on the market for sublease, but it's not vacant. You're still in it,
but
right?
It's still available,
exactly.
So that's how you...
Right, so what we look at is the availability rate, looking at all office space for lease or sublease in the country or in a metro area. And the result is, guess what? You have 40 to 70% more square footage available than you do vacant. Okay, so the brokerage community are running around saying, well, the vacancy is only 15%, but the availability might be 24%. And that's part of the reason we've gotten into this problem, is that our industry wants to kind of keep a veil on how bad it is. They don't want people to know how bad it is, right? Because that becomes power to the tenant. What we're talking about is this with transparency, so everybody understands what's available. It would be like saying you and your partner want to buy a house. You wouldn't say to your agent, show me the 3-bedroom homes that are vacant for sale. You would say, show me all the homes that are for sale, regardless of whether they're occupied or vacant, right? Well, and most people that have a home for sale are still in occupancy of their house. So why would we measure vacant homes for sale, right? We would never do such a silly thing, right? But in commercial real estate, they want to talk about vacant office space. Well, but what about all the space for lease or sublease that people are sitting in, right? The hundreds of millions of square feet that are available.
That are coming to the market, that are in the market.
That are on the market today that you could move your business into, okay, but that aren't technically vacant yet. So the problem is our industry gets a little diluted into believing that the market's actually better than it really is. And I think that's part of the reason historically why we get into these extreme cycles is because
there's build-outs based on those vacancy rates.
Well, if you have landlords, brokers, and lenders all looking at vacancy rates versus availability rates, they're going to falsely believe that the market is healthier and tighter than it really is. So with that mindset, they tend to overpay, overprice, overlend, overbuild, and we get into these cycles.
Now, David, you mentioned that some of these buildings are getting foreclosed. When we think about residential real estate, a lot of people understand that there's going to be a new buyer. But from what you're saying, they're getting foreclosed, but there's not really any tenants available. So probably there are no buyers for them. What does that look like when these foreclosures happen?
Yeah, so I would say there's a couple of different categories of foreclosures happening right now. There are high-rise assets that are commonly in the center city area.
So like towers.
Towers. And they're getting foreclosed upon where a new buyer is going to lower the rental rates and start having an unfair competitive advantage to acquire tenants. In other words, in downtown San Francisco, pre-COVID, buildings were worth $1,000 a foot. Well, if you're able to buy a building at $200 a foot in downtown San Francisco, instead of needing a rent up here, you can charge a rent down here. You could, in theory, undercut all the landlords that are trying to keep these annual rents of $80 to $100 a foot, and you could come in at $30 per foot per year.
And get a lot of people to move to your building.
And get your building leased over the next year or two, right? So, and that's what happened in the early 90s. These buildings started trading, and people that were buying them realized they could undercut the market, get their building leased, and cannibalize off everybody else, which created a vicious cycle because then those guys got foreclosed upon. That's what's coming. The other thing that's coming is, we've talked about conversions of office space to residential. The problem is 96% of all office buildings in the US can't be converted because the floor plate dimensions are too big, or they don't have the right kind of structure, the right
plumbing
kind of,
and all those things.
Right, building systems, the electrical, the plumbing, the window system, the exterior of the building itself, right, doesn't allow for conversion of residential to residential. So what you have is a situation where I see a lot of office buildings that are going to be purchased and torn down. I really think that's the future. We are in a cycle where when you look at what we call the highest and best use, right? Whenever we look at a commercial real estate asset, we look at the underlying land and we ask, what's the highest and best use for that land? Well, we know we have a housing shortage. You know, according to Zillow, we have about 4.5 million housing units in the United States that we're short right now. But we don't really have the permitted, entitled, well-located land to build those 4.5 million units. Meanwhile, I think we have about 500 million square feet of office space that we'll never need again around the United States. Most of that well-located in business centers, along transportation corridors, major arterials, with walkable retail and housing around it, right? What you're starting to see now are office buildings selling for the value of the land, minus demolition costs, and landlords going in and basically re-entitling that for residential development. I'll give you a real example. So in San Diego, there's a business center called the University Town Center, and there's a large landlord named the Irvine Company. They have 2 3-story office buildings on a major arterial called Genesee, across from a large mall, and they're going to be tearing those buildings down the end of this year, and in lieu, building some 6- and 7-story high-rises in their place. Okay, so you have about 90,000 square feet of office space that's going to go away, and they're going to build 400,000 square feet of residential space. And that's actually what cities want to see. In fact, the state of Texas is considering legislation that would make it illegal for any municipality to prohibit a developer from building residential on commercial land.
So it's going to be permitted, like you can just go and do it.
And I actually wrote an article for Forbes about this, that what needs to happen is municipalities need to immediately allow commercial land to be developed into residential. And the kind of residential I'm talking about are not single-family homes. We don't need more single-family homes. We need condos and apartments that are affordable, scalable for young couples, young families, retirees, couples with no kids, because those people don't need to live in single-family homes on half an acre. You know, those days are gone. We don't have enough land supply to build single-family homes anymore. We need to build multifamily. And we need to be building it not in single-family neighborhoods, which the state of California has become misdirected, right? Because they want to allow residential owners to build secondary dwellings on their property, or they want to allow developers to come in and tear down a block and build 6-story residential next to a bunch of houses around it. That is the wrong answer. The right answer is take all these commercial buildings where the underlying land is more valuable for residential, and let's get rid of the buildings. And that's what's coming. I think throughout the state of California and more broadly nationally, this story of conversion of office buildings to residential is going to be really about transformation of the underlying land to build a fantastic residential right in the heart of our communities, because that's what we need. Let's put the housing where the jobs are and where the transportation corridors are, and let's start solving the office problem simultaneously with the residential problem. That's where we need to go. And I further believe that we need to get municipalities out of the way of developers. In this process, municipalities want to charge developers water and sewer hookup fees, school fees, transportation fees. Well, if you're tearing down an office building that's already paid all those fees, why should the new developer pay any fees? It doesn't make sense, right? In other words, if an office building that's 20 stories tall had restrooms on every floor, and every tenant on every floor had dishwashers and sinks and kitchens, okay, and we're replacing that office building with a new residential tower, well, it's not going to have any effect on the sewage treatment facilities in the municipality, right? So if the cities can get out of the way from entitlements and all of the exactions that they charge on developers, all of a sudden we'll have more housing, faster and more affordable to solve this housing problem that we have as a state right now.
Now, David, do you think it makes financial sense for those tall towers to get demolished? Because they may not have a lot of land. Does it make financial sense for them?
Yeah, I think you're onto something here. There's a point of absurdity, right? There's a point where you have a 40-story tower on a block and tearing that tower down or dismantling that tower, because that's really, you can't blow it up, right? You literally have to take it apart the same way you put it together. You have to take the skin off the building, which is the glass, and then floor by floor, you have to dismantle that building, right? So that's going to cost tens of millions of dollars and take a year or two, right? And then replace that with potentially 2 residential towers, because you need smaller floor plates or a different configuration of floor plate that lends itself to residential instead of a huge 20, 30,000, 40,000 square foot floor plate. I don't think it's going to work in some examples, but there will be others where you have low-rise buildings, 10-story, 15, 20-story buildings where they don't consume as much of the land, and where now you can come in and build 2 residential towers that are 30 or 40 stories tall and triple or quadruple the amount of square footage that you got on the land, doing 2 more affordable housing, apartment, or condo developments for the marketplace. So I think there will be examples of higher buildings being dismantled over time as this plays out. Right now, it's more limited to sort of 3-story to 6-story office buildings, mostly in the suburbs. But I think over the next 5 years, as people start to realize this is really the future, and the office sector really plays out in terms of everyone now understanding how many hundreds of millions of square feet of excess office space we have around the country that nobody will ever want. I think it's the natural conclusion. I think it's where it ends. It may take 5 to 10 years to get there, but I think that's where we're going.
Now, in terms of the buildings that may not get converted, what's the impact of these buildings getting foreclosed and sit there empty?
It has a big effect, right, on municipalities, because a lot of municipalities, so some cities charge a rent tax, like San Francisco, for example, charges tenants a rent tax. There are cities that rely on tax revenue paid either by a tenant or by the landlord from the rents themselves. And obviously the underlying property tax is assessed as well, right? So if a building in San Francisco had a prior value of $1,000 a foot, and now it's $200 a foot, well, that tax basis comes down 80%, right? Because it's now taxed at its new value. And guess what then? All the landlords around them that have $1,000 a foot,
they're going to go negotiate with the city.
They're going to go negotiate with the city, because they're going to file what's called a temporary tax relief request. And they're going to say, my $1,000 a foot building is only worth $200. Look, there were 5 that were just sold at $200, and this is only what my building's worth. So they're going to get temporary tax relief as well. So as the whole asset comes down, the whole asset class comes down, you're going to see a tremendous negative effect on municipalities. States, counties, cities are going to have less tax revenue from commercial real estate. And that's what's playing out right now. And that's what I think city agencies and government agencies maybe have yet to get their head around, how much worse this is going to get in the next 3 to 5 years as these values trend down and it erodes the tax base of the region. Well, and then there's another effect, particularly in downtowns, that's playing out, because the people aren't coming back full time, and these availability rates are 25 to 40% in most downtown areas. Now, New York City's an exception. New York City seems to be stabilizing. Chicago seems to be stabilizing. But I fear that in New York City, it's sort of a false positive, because there were a lot of 10, 12, 15-year leases signed pre-COVID. And there's a lot of companies that are still floating around in excess real estate. So I think it's going to take another 3 to 5 years to play out in New York City, where it's playing out faster in other downtown areas. But when those people don't come back to work, it affects the immediate neighborhood. You know, the dry cleaner, the restaurateur, the local grocery store. The
little small businesses that are in that area.
Yeah, all the small businesses that we're selling into that ecosystem, right? Of in the case of New York City, millions of people coming into the business districts every day and consuming goods and services. You know, the business breakfast, the business lunch, the after-hour cocktails, the business dinners. It's all gone, and it's not coming back. Those businesses have been devastated in these downtown areas by the business community not coming back. And so there is a spillover effect into other retail and hospitality industries that's been quite harsh as well.
Who do you think will lose? In a sense, there will be a lot of losses, right? Is it going to be the banks? Is it going to be the owners? What does it look like?
Having been through the late 80s, early 90s, I've seen a version of how this looks. Since then, landlords have really been able to weather the economic storms of the tech wreck and the 08-09 financial crisis. This will be the first time you see a lot of commercial landlords, frankly, go out of business. I mean, you're going to see a lot of landlords essentially lose everything of what they've built over a career. Now, maybe they don't lose their houses and other isolated assets that they've been able to protect, but this will take some people down entirely and be career-ending for a lot of folks around the country. You're going to see a lot of brokers leave the industry because we probably have 30% more brokers than we need today. The market's incredibly over-brokered. It will certainly have a spillover into lenders, right? Because if you were the equity in the building, like let's say you had a $100 million building and you've got $70 million of debt, well, that $30 million came from somewhere, okay? That $30 million came from either your pocket, your investor's pocket, some LLC, some fund, some insurance company, some labor union, some pension fund. And now if that building's only worth $50 million, okay, that $30 million of equity is wiped out, and there's another $20 million of debt that's wiped out. So the lender's foreclosing, reselling the building for $50 million on a good day, right, maybe $20 million. The equity's wiped out. A big piece of the debt gets written off, right? So the lending community is going to get hammered by all this. So as these refinancing windows happen and they've got to refinance, lenders are going to take a lot of balance sheet hits coming. And then obviously municipalities take a hit on this as well. So it's going to be a bumpy 3-4 years until we start to try to find the bottom on this asset class. The only silver lining is that it's not all happening abruptly, right? This has taken 5 years to get here. We got another 3, 4, 5 years for this story to sort of play out. And if you look at past cycles, if you look at the early 90s, everything happened within about 2 years. And you look at the tech wreck, everything happened in 2 years. Same with the 08-09 financial crisis. I'm hoping that the economy has time to absorb this, right? I mean, there's going to be winners and losers, certainly. You know, the losers I've already described. Well, who are the winners? The winners are the entrepreneurs that are the multifamily developers, right? It's those people that pivot and realize that there's a huge open window both on market demand, community demand, the fundamental need of people for housing, right, to build more housing. And when you build more housing, what happens? It becomes more affordable. You know, we have an affordability problem because municipalities are standing in the way of developers, but also interest rates. But one other thing, you know, supply and demand. Developers haven't been able to build enough housing stock really in the last 20 years to keep up with demand. Only by loosening up the municipalities' exactions on developers and entitlements and speeding up the process and lowering the cost are we going to get more housing. And that's where it's got to go. And the sooner that the public and legislators all realize this, the faster we solve the problem.
David Marino, commercial real estate expert with Hughes Marino. It was great to have you on California Insider.
Thanks for the opportunity. This was a lot of fun.
Let us know your thoughts about California commercial real estate right now. And do you agree with the guest? You can always email me at siamak@californiainsider.com or comment. Remember, we read all of your comments and emails, and we'll see you next time.